The overall goal of retirement planning is to enjoy your retirement to the fullest without ever having to worry about running out of money during your lifetime. So how do successful retirees do this? Well, the more obvious answer is to not take too much income off your portfolio. And the reason for this is because the more income that you take from your assets, the more that you have to rely on the markets to make up for or at least offset your ongoing spending. In this video, I'm going to discuss a better way to quickly evaluate how much income can be safely spent from your portfolio in retirement. Hi everybody, my name is Michael Carbone and I'm a financial planner and a money manager in Greater Boston, and I'm here to teach you how to stack the deck and put the odds of retirement success in your favor. So how much can you safely spend from your savings and investments in retirement? Well, this can be a loaded question for many retirees. For example, say that a retiree is planning to take their Social Security benefits at the age of 70, but they'll also be retiring at the age of 62 and will no longer have their wage income. In that case, they're going to have 8 years before their Social Security kicks in, where they're going to need substantially more income from their savings and their investments than they will in their years after reaching the age of 70. So to spare you 3 hours of my babbling, I'm just going to reframe the question so that it can be applied to a wider audience. So instead of how much can you safely spend from your portfolio in retirement, the reframe question is based on how much you have saved today, how much can you safely spend from your portfolio each year, giving yourself a raise for inflation without ever having to worry about running out of money during your lifetime. An important concept to grasp here is that percentages are the great equalizer, especially in the context of retirement income planning. And the reason for this is that we're dealing with a dollar amount in terms of your savings that's fluctuating disproportionately with the amount that you're spending each year. So for example, you may earn a negative 20% return on your money one year, but your ongoing spending needs are unlikely to fall by the same amount. So it's always crucial to think about a sustainable withdrawal rate in terms of percentages and not dollars. So what percentage of your total available savings today can you safely spend throughout retirement? The first place to start is with the 4% safe withdrawal rule. And before I cover this, I highly suggest that you stick around to the end of the video where I'll expand on this concept and give you a way to estimate a sustainable withdrawal rate that's more tailored to your own situation. So the 4% safe withdrawal rule posits that the average retiree can take the total amount that they have in savings and investments today, multiply that by 4%, and take that amount, giving themselves a raise for inflation each year with extremely low risk of running out of money for at least 30 years. So for example, the rule suggests that if you have $1 million in total savings and investments, you can take $40,000 a year starting in year one and give yourself a raise for inflation in each subsequent year for a period of 30 years with very low risk of ever running out of money during that period. Some important stuff to know about this theory. So for one, it's a gross number. So when you do the 4% calculation, the withdrawal that you can take from your portfolio is likely less after you pay investment and income taxes. It's not a huge deal, but it's important to recognize and make adjustments for. Number two, it assumes a normally invested portfolio that's allocated roughly 50 to 60% in stocks with the remainder in bond or fixed income investments. So if your portfolio is invested more or less aggressively, then this may lead you to under or overestimate the amount that you can safely pull from your portfolio according to the theory. Number three, it assumes that your spending remains constant for the rest of your life, barring any inflation. In reality, most retirees' lifestyles will slow down as they get older and then balloon a bit during your later years as the potential for outlier medical and custodial care costs become more likely. And finally, it assumes a 30-year horizon, which just simply doesn't apply to everybody. For example, a 75-year-old is unlikely to live to the age of 105. So if you were to follow the 4% safe withdrawal rule in this case, you'd likely be underestimating how much can be safely spent from your savings. So how can you derive a sustainable or a safe withdrawal rate that's more tailored to your own situation? Well, I've conducted a similar study to help you do so. All right, so here's how it works. Let's take a look at the logic behind the 4% safe withdrawal rate, and then I'll show you how you can adjust it. So the hypothetical sum of money for this 65-year-old person on day one is $1 million, and they plan to live for 30 years. The withdrawal rate beginning in year one is 4% or $40,000. The annual inflation rate is assumed to be 3%. The historical returns are assumed to be an average of 10% a year for stocks and 4% a year for bonds. The portfolio is allocated 60% in stocks, 40% in bonds. So in any given year, the investment returns can range based on the underlying risk and return statistics of the portfolio. So for example, without getting into the weeds of the math behind volatility statistics, in this case, the portfolio's average return in any given year based on a 60-40 stock to bond allocation is assumed to be roughly 7.6% with an annualized volatility assumption of 10.28%. All this means is that in any given year, there's a roughly 2.5% probability that the portfolio return can be less than negative 13% or higher than 28%, or a less than 1% chance of the return being worse than negative 23% or higher than 38%. The more likely scenario is a portfolio return ranging from negative 2.68% to 17.8%. This is how a normal distribution works, and it's what most financial planning decisions are made on. So in year one, we start with $1 million, subtract out $40,000 of spending, and then add or subtract the random return based on the portfolio's underlying risk and return statistics. We do that same process for 30 years, 1,000 times, changing only the investment return in each year. What we get by doing this is an output, and the model's output now gives us 1,000 outcomes for year 30 that we can use to derive a probability that there will still be money left in 30 years. So in this case, roughly 90% of the trials, or 900 of the 1,000 trials, resulted in there still being money left after 30 years, which can be translated to a 90% probability of a positive outcome. This is widely considered an acceptable probability for the average person. William Benjamin's 4% rule uses actual historical market data, and this is a reasonable approach. My approach simply builds on it a little to capture the uncertainty in year-over-year market data in the future. All right, so moving on to determining an adjusted safe withdrawal rate that can be tailored to a more narrow demographic. All right, so for each of the following safe withdrawal rates, I'm using the same approach that we reviewed before. I'm just adjusting the assumptions that we're using to reflect different people of different ages with varying comfort levels with risk and uncertainty. So the first category is for those with an extremely low level of comfort with future uncertainty. Here are the assumptions. We're assuming a 99% confidence level, which means only 10 of the 1,000 trials resulted in no money being left at the end of the period by the life expectancy that we're assuming. We're assuming a 3% spending inflation. We're assuming a life expectancy at the age of 99. We're assuming that the expenditures stay the same throughout retirement. We're assuming an allocation of 20% in U.S. stocks, 70% in U.S. bonds, and we're ballooning expenses by $50,000 a year in today's dollars beginning at the age of 94. So in this case, for somebody that's the age of 60 today, their safe withdrawal rate would be 2.7%, 65 years old would be 3%, 70 years old would be 3.3%, 75 years old would be 4%, 80 years old would be 4.5%. Let's move on to the next category. For below average comfort level with uncertainty, we're using a 90% confidence level, a 3% spending inflation, life expectancy of the age of 95, no spending deflation, an allocation of roughly 40% U.S. stocks, 60% in U.S. bonds, and we're ballooning expenses by $30,000 a year in today's dollars beginning at the age of 90. For the more average person, we're assuming a 90% confidence level, a 3% spending rate of inflation, a life expectancy of 95, so we're slowing spending, right? Remember I said that the average retiree, their lifestyle slows down, so we're slowing their spending slowly at the age of 75. We're assuming a 60-40 allocation between stocks and bonds, and we're ballooning expenses by $30,000 a year in today's dollars beginning at the age of 92, so for 3 years they'll have incremental costs. And for the above average category, we're assuming an 85% confidence level, a 3% spending rate of inflation, a life expectancy at 95. We're going to slow spending moderately at the age of 75, and we're assuming a 70% allocation to U.S. stocks, 30% to U.S. bonds, and we're not going to balloon expenses. Feel free to pause the video and take a screenshot if you think this table might be helpful to have just for reference. But let's apply an example to this. So say that you have $2 million in financial assets and you're the age of 65. Let's assume that you consider yourself to be slightly conservative, slightly more conservative than the average person, but at the same time, you recognize that there will always be uncertainty, and you just prefer to err to the more conservative side of the spectrum when making financial decisions to help you sleep better at night. So in this case, you'd be in the below average category, subjectively, where the safe withdrawal rate for a 65-year-old is around 3.8%. So if you have $2 million, you'd be looking to take no more than $76,000 from your portfolio each year, giving yourself a 3% raise for inflation each year. I hope you found this video and this information to be helpful, but before I let you go, I just want to spend a few moments just going over or reviewing the drawbacks to relying on this as an exclusive decision-making tool. You really shouldn't. Although I do believe that using a withdrawal rate can be a really good tool and it can give you a lot of valuable insight for your retirement planning needs, they do not reflect your situation on as granular of a level as needed to make an informed decision. At the very least, you should be reviewing your situation regularly to ensure that it still aligns with your personal circumstances. When you're planning for retirement, you should be considering when you're going to file for your Social Security benefits, timing of other income sources that you might have. You should be considering your taxes, your investments, the outlook for the markets and the economy, and so much more. It's truly an evolving process. It should be reviewed regularly to ensure that your evolving situation is planned for. I mentioned earlier that I'm a financial planner, and I really try not to sell myself in these videos, but I do think that there are a lot of people in this country that are in need of financial guidance and financial advice. So if you feel that you'd benefit from setting up a complimentary call with me, then click the link in the description of this video. It'll bring you right to my calendar and we can set up a call. But as always, I wish you the very best of luck and I hope to hear from you soon.